The first high-growth stock in India is Apollo Microsystems. AMS is currently positioned as a high-growth intelligence layer in India's defense sector. Rather than building large platforms like jets or tanks, AMS specializes in complex electronic and electromechanical systems, which are the brains that allow these platforms to function in extreme environments. For example, they develop mission computers, guidance and navigation interfaces, and telemetry systems that are critical for the Agni and BrahMos missile programs. The company is experiencing hyper-growth in its top and bottom lines. Its net profit surged 91% year-on-year to 30 crores, and revenue grew 40% year-on-year to 225 crores. The EBITDA margins expanded significantly from 20.3 to 26.5% over the last year, indicating that the company is becoming more efficient as it scales. Analysts project a revenue CAGR of 45 to 50% over the next 2 years, driven by the core defense business. In December 2025, the company announced a massive 1,500 crore investment in Telangana to manufacture warheads, rocket motors, and artillery systems. It recently received DRDO approval for laser-based weapon technologies, placing it in the next-gen defense bracket. Recent major wins include a 420 crore deal from Coal India, which is at a subsidiary level, and 150 crore in defense electronics as well. The total project pipeline is estimated to be near 7,800 crores. Its main weakness, though, is the negative free cash flow. The company consumes significant cash for working capital and expansion, which can lead to frequent equity dilutions. The second is Sandur Manganese and Iron Ores. Sandur Manganese and Iron Ores Limited is currently in a transformational phase as of January 2026. After decades of being a pure-play miner, it is aggressively pivoting towards downstream steel production and significantly expanding its mining capacity. The most significant change is the acquisition of Urjas Steel Private Limited, which was completed in 24-25. Previously, Sandur just dug ore out of the ground and sold it. Now it owns a major steel manufacturer. Urjas is a leading player in specialty bar quality steel, serving the automotive and industrial sectors. Sandur can now use its own captive iron ore to feed Urjas Steel's furnaces, drastically reducing raw material costs and capturing the profit margin that previously went to other steel makers. The 2026 outlook for Sandur is defined by major regulatory approvals that have unblocked its production ceilings. In late 2025, the Supreme Court's Monitoring Committee and the KSPCB granted CFO expand, which is consent for operation. This has boosted iron ore capacity to 4.36 MTPA and manganese ore to 0.49 MTPA for the 26-28 period. The company is implementing a 1.2 kilometer downhill pipe conveyor system. This is a critical data point because it drastically reduces logistics costs and environmental footprint, directly padding the EBITDA margins. The strategic acquisition of Urjas Steel marks its entry into high-end specialty steel, moving it up the value chain from a commodity miner to a value-added manufacturer. Gabriel India is next, and it is currently undergoing a massive structural transformation in 2026. Historically known for shock absorbers, the company is pivoting to become a diversified mobility solutions provider through a major group-level restructuring and high-growth joint ventures in the EV and Sunroof segments. The most critical catalyst for Gabriel is the upcoming merger of Anand Group's auto component businesses, Dana Anand, Henkel Anand, and ACYM, into Gabriel India, which is effective from 1st April 2026. This moves Gabriel beyond suspension into drivetrain products, transmissions for EVs, and specialty adhesives. Management projects this restructuring will be significantly EPS accretive, which is a projected boost of 7 rupees per share, expanding the company's scale without adding debt. The JV with Inalfa in Sunroof business is also gaining traction. As the Indian car market premiumizes, sunroofs are becoming a standard feature. Gabriel now serves major OEMs like Hyundai and Kia. The new JV with South Korea's SKM Move targets high-growth segments like EV thermal management fluids and engine oils with a long-term revenue target of 500 crores. The company's exports also grew by nearly 60% in the first half of FY26 as the company expanded its footprint in Europe and the Middle East for solar dampers and e-bike components. The next stock is NLC India. It is currently a standout performer in the PSU energy space. The market is currently rewarding NLC India for its operational turnaround and aggressive capacity expansion. It is also significantly undervalued at a PE of about 15 versus a sector PE of about 40. NLC India is in the middle of a massive capex cycle as well that analysts expect to triple the company's size by 2030. The company has already commissioned over 1,483 megawatt of renewable energy capacity. New projects, including the 300 megawatt solar project in Rajasthan and the JV with PTC India for an additional 2000 megawatt, are the primary drivers for the stock's valuation. In December 2025, NLC's joint venture, NUPPL, began mining at the Pachwara South Block in Jharkhand. This secures long-term fuel for the thermal plants, insulating them from global coal price shocks. The company is moving into grid stability with a 250 megawatt to to about 500 megawatt hour BESS project, positioning it as a modern utility provider rather than legacy miner. BESS is battery energy storage systems. NLC India is a value buy for investors who want exposure to the green energy transition at a fraction of the cost of private sector peers. AIA Engineering is next, and it is a global niche leader in the manufacturing of high chrome mill internals, which is grinding media, primarily serving the mining, cement and power sectors. Grinding media are hard, loose bodies like balls, rods or pebbles used inside mills to crush, grind or mix materials by impact and abrasion. It reduces particle size for industries like mining, cement, paints and pharmaceuticals. The company is investing about $50 million to set up new grinding media plants in China and Ghana as well, with capacities of about 50,000 tons each. In late 2025, AIA secured a major deal, $33 million in size, with a Chilean copper mine. This is viewed as a beachhead into the massive South American copper market, which is shifting from traditional forged balls to AIA's high chrome solutions. Management has signaled a target of about 30,000 tons of annual volume growth for 2026. While revenue was flat into late 2025, this volume jump is expected to drive the next leg of earnings growth. Over 90% of AIA's revenue comes from exports. Any global slowdown, whether in copper or in gold, directly impacts the replacement cycle orders. So, any economic slowdown must be looked at before investing. Data Patterns is next, and it is a high-growth, vertically integrated player in India's defense electronics sector. In Q2 FY26, revenue skyrocketed 238% year-on-year to 300 crores, driven by the execution of major domestic contracts. The net profit for the same quarter rose 62% year-on-year to 50 crores about. The current order book stands at approximately 1,000 crores, with an additional 550 crore under negotiation. The company successfully delivered its first fully export-developed transportable precision approach radar TPAR to a European country. This validates its global competitiveness. It remains a key supplier for high-profile programs like the LCA Tejas, BrahMos missiles and various electronic warfare systems. Data Patterns is a quality defense play that is currently consolidating after a period of immense growth. Unlike some of its peers, it has a cleaner balance sheet. It must be bought on dips though, not on rallies. This, however, has to be a part of any portfolio built on India's growth story.